Over the past year, REIT share prices have crashed, and as a result, their valuations are today the lowest since 2008. There just doesn't seem to be much investor appetite for REITs in a world with 5% yielding money market funds. Just to give you a few examples, here are 3 comments that I recently received on my YouTube videos. So here's the first one. No sense in owning REITs yielding 5.5% when I can get 5.2% from a money market fund. And then the second one, when you get a 5.2% risk-free in a money market fund, why take future market risk with a REIT that has lost value to the extent higher interest rates will translate into lower FFO growth going forward? And then the third one, I think the bonds are the better choice for the short term. Up to 2025, yields are higher than dividends. I'm receiving a lot of these comments right now from people claiming that bonds are better investments than REITs because in many cases they offer higher yields. Moreover, these comments tend to get a lot of likes, so clearly there are a lot of people who think alike. But I think that this is very short-sighted, and in a moment I'm gonna explain to you why. Hey everyone, this is Jussi. I'm a CFA charter holder but not a financial advisor, so make sure to do your own research. I run a small investment firm that specializes in REIT investing, and in today's video I want to give you 2 important warnings about REITs. But before I get into it, could you please do me a huge favor and like this video? That will really help me a lot to grow this channel. Thank you so much for all your support. So my first warning to you is that REITs are not bond replacements. A lot of people right now appear to think that just because the dividend yield of a REIT is lower than that of a money market fund or a bond, then it means that you should avoid REITs. But this just doesn't make sense, because REITs are not just income investments, they are total return vehicles, and the dividend is just one component of the total return. Historically, REITs have earned about 13% average annual total returns, beating even the returns of the S&P 500, and the dividend only made up about half of these total returns. Here we can illustrate this by looking at a real-life example. Vici Properties is the biggest casino REIT. It owns trophy assets such as the Caesars Palace in Las Vegas, as well as the Venetian. Today it's priced at a roughly 6% dividend yield, and so by the logic of many investors, it should be avoided because you can earn just as much by investing in bonds. But what these people ignore is that Vici has also guided to grow its FFO per share, which is the equivalent of the cash flow per share, by roughly 10% this year alone. And so here, if you add the 6% dividend yield with the 10% growth rate, you get to total returns in excess of 15%. And by the way, this is nothing exceptional for Vici. This is roughly what it has achieved on average annually since going public. Now we can take this a step further and assume that Vici will only grow by about 5% per year growing forward because of the now higher interest rates. 5% annually should be very doable for Vici because most of its leases include CPI-based rent escalations. It also retains about 35% of its cash flow to acquire new properties, and finally it has relatively low debt and long debt maturities. But even with such a modest growth rate, you could expect to earn roughly double-digit total returns as you add the 6% dividend yield with the 5% annual growth rate, resulting in an 11% annual total return. And so here you need to ask yourself, would you rather earn a 5% yield from a money market fund, or would you rather earn a double-digit annual total return from a REIT like Vici? I think that this question is pretty simple to answer. After you deduct inflation, this 5% yield from the money market fund will return in a 2 to 3% real return, which will not really get you ahead. And so unless you're petrified by volatility and have a very short investment horizon, I really don't see much point in holding a lot of capital in such a money market fund. On the flip side, if you have the discipline to hold through times of volatility and have a long investment horizon, you will likely do way better by owning REITs like Vici over the long run. The big difference here that people appear to overlook is that REITs are real estate investments. They benefit from inflation as it results in higher property replacement cost as well as higher rents, which over time then lead to cash flow growth as well as appreciation. And now comes my second warning. And that is that today's high interest rates may not last for very long. Investors are quick to extrapolate recent trends far into the future, but it's important to remember that the recent surge in interest rates was the direct result of the high inflation which resulted from the pandemic as well as Russia's brutal invasion of Ukraine. But now this inflation is gone already. The latest CPI reading was about 3%, and if you adjust for real-time shelter, it is already below the Fed's 2% target. Many are today quick to assume that we're gonna stay in a higher for longer environment, especially after the Fed's recent comments, but if you look back in history, you'll see that over the past 40 years, every rate hiking cycle has been followed by steep interest rate cuts in the following years. So you need to ask yourself, will this time be different? I myself don't think that it will be. We are today still dealing with the exact same deflationary forces that resulted in this long-term downtrend in interest rates, and in fact they've even gotten stronger in some cases. Governments around the world are more indebted than ever and they cannot afford these high interest rates for very long. The population is also still aging rapidly, and then finally we recently also made major breakthroughs in new technologies such as AI and robotics, which are significant deflationary forces. So I just don't buy into the higher for longer narrative. I think that eventually something is going to break as the economy starts feeling the pressure of the higher interest rates and the Fed will again be forced to cut interest rates. Today, the debt market is already pricing significant rate cuts in the near future. The yield curve is heavily inverted. This has historically been one of the best indicators to predict the coming recession and what happens when we go into a recession. Typically, the Fed cuts interest rates. And if you agree with me that interest rates are likely to go lower in the coming years, then that's one more reason to buy REITs instead of bonds or other fixed income investments today. That's because, for one, if you put your money in a 5% yielding money market fund, that yield may not last because as interest rates go lower, your yield on the money market fund is also going to drop very significantly. So you may think that you're earning a 5% yield on your money market fund, but if 6 months from now interest rates are lower, your real yield will actually turn out to be quite a bit lower as well. And then for two, REIT valuations are today heavily discounted. They're trading at their lowest valuation since the great financial crisis, and this is primarily because of the recent surge in interest rates. But if now interest rates suddenly return to lower levels, this should serve as a strong catalyst to unlock upside across the REIT sector. Today, the average FFO multiple is just around 13 times. If that expanded back to just 16 to 18 times FFO, which would still be very reasonable, you could add another 5 to 10% of annual repricing upsides to the returns that we discussed earlier. So again, let's take the example of Vichy Properties here. You have a 6% dividend yield, you have a 5% annual growth rate, and then you add to that 5 to 10% of repricing upside, and now you're getting closer to 15 to 20% average annual total returns. So once more, will you rather earn a 5% yield on a money market fund, which may not last and may not even be real because maybe 6 months from now interest rates will be lower, you also don't have any inflation protection, or would you rather earn a 15 to 20% expected future annual total return from a REIT like Vichy Properties? It of course depends on your time horizon, your objectives, and your risk tolerance. For some people, the money market fund is a good solution, but I hate to see people who have a long investment horizon and a good tolerance for risk decide to replace their REITs with money market funds, when in reality I think that they should be doing the opposite in today's market. There are some truly exceptional opportunities in the REIT sector today, with a lot of high quality REITs trading at just half of where they were just 1 year ago. Most of these REITs should do reasonably well over time, even if we remain in a higher for longer interest rate environment. That's because they're now priced at insanely low valuations and high dividend yields, and then on top of that they keep growing at a steady pace because they're not heavily impacted by the surge in interest rates, as they use low debt, have long debt maturities, and meanwhile their rents keep on growing. In fact, if you expect interest rates to remain high, then I would expect this rent growth to even accelerate in the coming years, because it will stop new property developments. It will also grow the pool of renters because real estate ownerships will be less affordable. And even better, if you think like me that interest rates are likely to return to lower levels in the coming years, then there are a lot of REITs that could present 50 to 100% upside potential in addition to their yield and their growth. So please don't make the mistake of replacing REITs with fixed income investments just because their yield might be slightly lower at the moment. The reason why the yield is often lower is simply because REITs retain a lot of their cash flow to reinvest in growth, and it's really this growth that's going to make a difference over the long run. Now finally, if you want to access my entire REIT portfolio, feel free to join High Yield Landlord, which is my REIT newsletter. For a 2-week free trial, I'll put a link to it somewhere in the description of this video. And otherwise, once more, if you could please like the video, it'll really help me a lot to grow this channel. Thank you so much for your support, and see you at my next one. Bye bye.